Okay, welcome guys. This is Business Evaluation 1. This is about preparing financial statements. So this is going to go through one of the hotels in the small booklet. This is in the final exam, so I'm just going to go through the steps, the processes to think about, to actually look at. Okay, so yes, I'm Murray Thompson, sorry I didn't say. Yeah, we're just going to walk through one hotel. I want to make sure you understand the process so that even if the numbers change, you still know what to do. You still know how to do it. So I'll be doing it on screen, but just imagine you're doing it on paper or on canvas in the exam. And these are the decisions that you have to follow. So I'll bring it up on screen. Right. So here we have a screen. Just make sure it's fitting in. Good. So this is our example. It's the amazing Fallen Oak Hotel. This is what you're given. You're given the trial balance. This is always the starting point. The trial balance is the starting point in our process of doing financial statements. Here are the steps that we're going to be working through. So first step is we're going to go through and we are going to analyse the trial balance. So we're going to go through, identify each of the accounts, identify what they belong to, what element, or where they belong to. So that's the first step. Second step is we're going to walk through the departmental accounts, one for the food, one for the bar. After that, step 3 is we do an income statement, and then finally we do a balance sheet. So I'll walk through each of those as we go through. Okay, so this is your starting point when you're trying to do financial statements. Now, all these things on the left-hand side, these are our debits. These are on the left side. So anything up here, these are our assets and our expenses. These guys over here, these are all credits. So these will be our liabilities, owner's equity, and revenue items. So those are those. Okay. Now, to go through these, it's often helpful to look at the chart of accounts. So I'll bring up the chart of accounts. Now, you do have this document that you can access in Canvas. Now, this is quite handy because it looks at every account name that we have. For example, the bank account is one name, and it categorises it under what element it belongs to. So we've got bank, debtors, inventory on hand, vehicle, computers. These are all examples of assets. So these are things we own. The liabilities, these are things that we owe to other people. So these are our creditors, our suppliers that we owe, bank overdraft, for example, things like that. Then we have owner's equity, which normally just has capital and drawings under it. And then we have our revenue items. So we've got sales, food sales, interest received. If it's got received in the name, it's generally a revenue, something that we earn and we get to keep the money. And finally, expenses, which are costs to the business. These are running costs to keep us going. So purchases, salaries and wages, telephone, advertising, yeah. And if it's got paid in the name, it generally will be an expense. Okay, so go back into Canvas if you need this chart of accounts. And it's also on the J drive as well. Okay, so the first step is to actually work through and categorize what each item is. So I've already said these things on the left, they're on the left side of the accounting equation. So these are our assets and expenses. Now the other split that we need to do is for the balance sheet, we're going to look at what is current and what is non-current. So this is going back to week 1. So current is anything that is cash or will be turned into cash or used up in the next 12 months. Non-current, things that we're going to hold for the longer term. Okay, so longer term things are like buildings, vehicles, computers, equipment, things like that. Okay, so bank account, that is a current asset, and yeah, you just go through. And telephone expenses, well, it's in the name, that's an expense. Purchases food. Right, now we come to a bit of a roadblock. we're going to be doing departmental accounts. So we're going to be doing departmental accounts as part of this. So if there is food in the name, if there is a bar in the name, that will be used specifically for those departmental accounts. So instead of just blindly writing expense, that's not quite correct. We need to write that we're going to use it in the departmental account. Okay, so you can write something like food department, might be FD for example, and that takes note that you'll use it in the food department. Computer, that's a non-current asset. Interest paid, that's an expense. Stationery, that's another expense, even though yes, you do have some at some points. Stationery definitely is an expense. Furniture, non-current asset. Vehicles, again, a non-current asset. Debtors, these are customers who owe us money, and so yes, we want to get cash back from them within a year, so that's a current asset. Wages, that's an expense. Land and buildings, non-current asset. Purchases bar, again, this is a departmental account item, so we can put our department. Equipment is not repairs to equipment, this is the actual equipment we own, so do make sure that you put it as non-current asset. We're going to keep it for a long time. And finally we have opening stock food, so again food is in the name and bar is in the name with the next one, bar department. Okay, so we've just categorized our left-hand side. So we've already done the left-hand side, they're all our debits, they're all our assets and expenses. Some of them relate to food and bar department. Now you can do the same for the credit side as well. So the credit side are our liabilities, owner's equity, revenue items, because they're on the right-hand side of the accounting equation. So the balance, if there's a balance there, that's normally a credit. So again, go through each item and we're going to categorize which element they belong to. Pardon me. Capital, that's easy, that is owner's equity. Sales food, again it's food in the name, so it's going to be used in the food department. Bar sales, so it's bar department. Now we've just got sales accommodation. So this doesn't relate to any departmental account, so it's just a revenue item. Note that the last two items were also revenue items, but we will use them predominantly in the departmental account. So that's just revenue for revenue. Then we've got a mortgage. So mortgage is a long-term liability when we buy a building. So we go to the bank and we ask for some money to buy a building. A mortgage is what we owe on it. So that's a non-current liability. Now we've got creditors. They're our suppliers that we owe, and we're going to pay them within 12 months, so that's a current liability. Interest received, that's a revenue, and GST, that's what we owe the tax department, so we're definitely going to pay that in the next 12 months, so that's a current liability. Okay, so we've analysed the trial balance. That's the first step, and if you do that properly to start with, that will help you in the next 3 steps, because you'll actually be able to use your coding and actually start ticking things off as you use them in step 2, step 3, step 4. So here we go. So we'll bring up the steps. So we've analysed the trial balance. Next we do a departmental account for our food and a departmental account for the bar. Right, so I've got this blank spreadsheet that I'm just going to work on, and I'm going to put the departmental account just on one tab. So we're just going to put, we'll do the food department first. So I'm just going to call it food departmental account. And this is for the amazing Fallen Oak Hotel. And well, that's not quite right time, that's right. And then for the period ending 31 December 16. Okay, for the amazing, I might just change that. Amazing. Right, so departmental accounts. These look at the department performance. So we've got the food department and we've got the bar department, and we want to tell, well, how much profit is each made. Now, this will be the gross profit is the end result of what you're going to get out of this section. So, first up is what we receive from our customers. So, for example, food sales. Then we're going to minus this thing called cost of sales. Now, you can go back to Canvas. There's a section there on cost of sales, and you'll find it there and the calculation there. But the calculation is we take our opening stock, we add purchases. Now that might go funny because I need a little dash in there. Okay, plus purchases minus a closing stock. So opening stock plus purchases minus closing stock equals cost of sales. Right, and when we finally come down to it, food sales minus cost of sales equals gross. So there's actually two formulas here. I'll just put this one down here. Sales minus cost of sales equals gross profit. And then you've got the other one, the other formula for cost of sales. Okay, that's the two formulas that we will be using. So, food sales. All you do is consult back to your items. You're looking at the food department. So, we find our revenue item. This is what we earn from our customers. Here we go, food sales. So we're just going to put that in, 650,000. Yeah. Opening stock. Opening stock is right here for food, 63,000. Now note that I'm using two different columns. This is the right-hand column is generally used for totals. This left-hand column is used when you are adding up things to get to a total, which we'll be doing for cost of sales. I've just put that in the wrong box, I realised. Okay. So, purchases. Purchases for food, we've got 196,000. Again, that's an expense, so that's on the left-hand side. And now we want to minus closing stock. Okay, now you note that closing stock isn't on the trial balance. So it's not on it's no item on the trial balance. And that's okay, because you have to look down. You have to look down to the bottom part. And it says down here, you've been given the following trial balance. A stock take was carried out this morning, the 1st of January 2017, with totals for 76,000 for food, $34,000 for the bar. So this information here, that is our closing stock figures. And that's what you need to put into the departmental account. But also, those inventory figures, they'll also appear to the balance sheet because we actually own that much stock at the end of the period. Okay, so we put in our closing stock. We put 76,000 for food. Okay, now because I'm in Excel, I can do a little formula. So I'm just going to go opening stock. We want to add on our purchases, and then we want to minus our closing stock. And this gives us our cost of sales. So if you think about it, this is our restaurant. This is how much money came into the department from our customers. And this is how much it costs to restock all the shelves, all the refrigerators, with all the food that we sold during that year. Now the difference between the two is gross profit. This is how much money we actually made during that year. So that's sales minus cost of sales is gross profit. So again, because I'm in Excel, I can do that. Okay, and that is our gross profit. And that's one departmental account. That is the departmental account for the food department. Right, we're going to do the exact same thing for the bar now. So I'll just copy these cells because we're going to use the exact same layout. And you can do this in the exam actually. You can copy some of what you do. You can actually do copy and paste. But now we're going to move on to the bar department. So yes, big hints for the exam. You can actually copy and paste cells and save you a lot of time setting it out. Okay, so now our focus is looking at our bar department. So the bar department, that's what we call just focusing on what we sell in terms of alcohol, drinks. This is just the sales that relate to the bar. So we've got bar sales. Now, I know these figures aren't right, so we're going to change them up. So we look for bar department. So now that's a bit less, 320,000. Okay, I'm just going to reduce these to 0. Now, then we have our cost of sales. Again, opening stock for the bar, we find on the trial balance, 47,000 we had at the start of the year. Then we purchased some bar items during the year. The total of the purchases was 85,000. And then closing stock. Again, this is the additional information, 34,000 for the bar. 34,000. Okay. And so opening stock plus purchases minus closing stock gives us our cost of sales. So again, this is what we received from customers in the bar. This is how much it costs to restock the bar. That minus that gives us our gross profit for the bar. So that is the departmental accounts. So you know you've done it right when you've got 2 departmental accounts and you've calculated the gross profit for each one. So just do remember these 2 formulas. You do need sales minus cost of sales is gross profit, and then how to make up cost of sales. Right, so that is step 2. Step 2 done, departmental accounts. Step 3 is an income statement. Okay, so the income statement, the departmental accounts have just looked at one department only at a time, so food department, bar department. The income statement actually brings the whole hotel together. So we start to look at the performance of the whole hotel. So what you'll find is that we want to get the performance of the departments we've just calculated, but also the other departments that are there. So, and again, I'm going to bring up a new thing. I'm just going to copy these headings to use here, and I'm going to say this is our income statement. Now, on the income statement, there are 2 elements that are used, 2 sections, revenue and then expenses. Now, revenue minus expenses will give us our net profit if the figure is a positive figure, or it could be a loss if it's a negative figure. Depends. But this is 2 of the 5 elements. So remember, think back to the 5 elements. There are only 5. We use 2 of them in this income statement, revenue and expenses. The other 3, assets, liabilities, owner's equity, that will be done in the balance sheet. Okay, so revenue. So we think about, well, what's our revenue of the whole hotel? Now, first part to put in is to put in the gross profit that you've just calculated for each department. So the gross profit for the bar department, gross profit for the food department. I may have swapped around those orders, that's okay. The order does not matter in these lists here. Right, so what you would do is, here is the gross profit for our food department. Here is the gross profit for our bar department. Those are items that we put under revenue. Okay, so gross profit for the bar department was 222,000. Gross profit for the food department, 67,000. Right, now we look at, well, what other revenue do we have? So we go back to the trial balance again. We look at the credit side, and now we look at anything that we haven't used in terms of revenue. Important thing is not to reuse things that you've used on the departmental account. I'm going to go webcam on this. Do not reuse items that you've used on the departmental account. Okay, really important, because it will double up the figures. You've already used it once on the departmental account to create the gross profit. So things like sales, purchases, you've used it once, that's it. You don't need to use it again. Important step. Now, so what you're looking for is other things that you haven't used yet. So look for the things that say are. Okay, so we've got sales accommodation. Makes sense. Doesn't belong to any departmental account that we've used yet. So sales accommodation is 99900. Then anything else? Yes, we have interest received. Again, remember, if it's got received in the name, probably be revenue. So that's 2,500. Okay, so that's all our revenue items. We've got 4 items. So then we put in an item for total revenue. And remember, we're going to use a totals column. So I will just do a little formula here, equals this plus this plus this plus this. And that's our total revenue for the Amazing Fallen Oak Hotel. Right, so then we have expenses. Now these are other expenses. These are other expenses that don't relate to any one department. So we've already done some purchases that are expenses that are related to food and bar. We don't, again, reuse those. We want to look for other things. So just run through the list. Doesn't have to be in alphabetical order, but just anything with an E. Now we start putting it in. So we've got telephone expense. Telephone expense, so that's 12,000. Looking down, we've got interest paid. Again, if it's got paid in the name, it will be an expense. 6,000. Okay, we have stationery. Now, stationery is one of those little funny ones where technically it is an asset where you do have a stock of stationery going all at once. But what will happen is that you buy stationery, you buy paper, you buy pens, and you use it within a month or two. So because you use it very quickly up and it doesn't last a year, we just say it's going to be an expense. Let's not bother trying to keep track of how much stationery you have. But some organisations will keep track of stationery records and actually keep their stock levels of how much they have on hand. Okay, so stationery is there, and finally the big one is, of course, wages. So we haven't put in any wages yet, so these are all the people that we employ. So there we go, we've got all our expenses. Now there might be others, depending on your scenario. Just make sure you identify them correctly from the chart of accounts. So again, we go total expenses, we add these all up, and we have our total expenses for this hotel. Right, again, net profit, remember that is revenue minus expenses equals profit. So we take what we've received from our customers minus what we have paid out to run our hotel, and that will give us our net profit. So net profit is what we get to keep at the end of the day. So it's a positive figure, it's profit, hooray. If it was a negative figure, that would be a loss. Right, we move on. We've actually done 3 out of the 4 steps already. Step 4 is the balance sheet. So the balance sheet uses the last 3 elements. It's a bit more involved because we're going to be doing the current and non-current split. So it does take just a little bit longer time. Okay, so we'll just get rid of that. So I'm just going to copy this balance sheet. Right, so we're going to create a balance sheet now. Now, balance sheet isn't actually for a period at all. It's actually as at a particular day. So if you were to say, say for example, what is your bank balance at this date? Well, that's what the balance sheet will show you, because it has to be as at a particular date. So normally it's at the end of the period. So say for example here, we're looking at one whole year up until the 31st of December. These are the account balances as at that date. So this is the things that we own and their values at that date, and the things that we owe and the balance of what we owe at that date. So I'm going to change this. So as at 31 December. Don't worry, in the exam that will be preloaded in for you. Okay, so a balance sheet uses the other three elements. First of all, we get into owner's equity. So owner's equity is one of them. Then we have assets. And I'm going to make a bit of room, but I may have to shimmy liabilities down later. And liabilities. The last part that we're going to have on here is a little thing called net assets. Now this is a formula. So this is your total assets minus total liabilities. So total of what we own minus the total expenses. And hopefully it should equal, if you've done it right, your total of your owner's equity. So that's the whole key of a balance sheet, is to actually get this item here, net assets, to equal what we're going to put into owner's equity. Right. So now we go through and figure out what we need under each of these elements. Again, go back to the trial balance that you've analysed, and you'll see that first up we have owner's equity. Owner's equity is on the right hand side because it's a credit balance, and we have here capital. So capital is what the owner has introduced into the business. So put that in. Okay, the last other thing that we need to put in here is our net profit. Now, the net profit belongs to the owner. Net profit belongs to the owner. The owners get to keep it, and so that also gets added to owner's equity. So if there's a profit, it's going to increase owner's equity. If it's a loss, it will make it go down. So net profit. So here I'll just, again, copy from your income statement. Whatever the result from your income statement was, that is the number that we will be copying into our owner's equity. So I'll put it here, 622,380. All right, and now I'll just make a little item here, total owner's equity. And because I'm in Excel, I can do this formula. Again, in the exam, you won't have that ability. You're going to have to do it by hand. Right, now we get into assets. Now, we're going to have to split our assets and our liabilities. So we're going to split what's current and then what's non-current. Now, I talked about that before. Current is within 12 months. Non-current is a long-term outside of 12 months. So go through and find what are our current assets. That'll be our first thing. Our first one on the list is our bank account. So our bank account, we have 32,000. Right, and when you look through the list, you go, right, oh, there is no other current assets here. But don't forget about inventory. Again, if your balance sheet doesn't balance, this is probably the number one reason why it doesn't balance. You've left out inventory. Inventory is an asset at the end of the year, and so we do need to include it. So we do need to include the closing stock figures, so you can just put inventory food, inventory bar, and put the totals of what they are. 36,000, 34,000. Now you've got all the current assets. No, we don't. There's one more. What have I missed? Aha, debtors. Debtors. Debtors, or next to it, it says accounts receivable. You can choose what name you want to put it. Accounts receivable is the more formal name of debtors. Okay, now we have it all. Total current assets. Okay, and we total it up. Okay, so we've got 194,000 in current assets. I will have to insert a few more rows. Right, now we get into our non-current assets. Now, non-current assets, these will be the things that we've identified on the trial balance that we're going to keep for a long time. So, again, doesn't have to be in any order, just pop them in as they come up. So, computer, 600, furniture, there's another one, 900,000. If it's a bigger value, then it's probably going to be a non-current asset rather than an expense. Okay, land and buildings, 1,200,000, and finally equipment. Okay, equipment, 650. Oh, there we go. So we've got our non-current assets. Non-current assets. Now, if you're in the exam, what's a good idea is as you use them, tick off these items. That way you'll be aware if you have missed one of these items. If you miss it, it won't balance on the balance sheet. So that's another reason for going back and checking. Okay, so we add up our non-current assets. Okay. So we've got the things that will be turned into cash in the next 12 months. We've got the things that we're going to keep. So now we need to add them together for the total of everything that we own. So total current assets plus the total non-current assets. So that is, so they own, this hotel owns $2,969,600 worth of assets. Okay. So now we move into what we owe, the liabilities. Now liabilities, again, are on the credit side because they're on the right-hand side of the accounting equation. So you'll find them on the credits. Again, we look at current liabilities. What are we going to pay in the next 12 months? So we have creditors. We want to pay our suppliers. Okay. So creditors, 25,000, and GST. So we've just got 147,220. And that is all our current liabilities. So again, I'm going to total them up. Totals go in the right-hand column. So this, what's this? 172,000. Now we come to the last portion of liabilities, and we have non-current liabilities. These are our long-term liabilities, and we only have one. We've got our mortgage here, the mortgage that we had to have to buy some buildings. So we'll put in the mortgage. So that is 1350. So then we go to total non-current liabilities. Okay, 1350. Okay, I'm just going to need a couple extra lines. Okay, so this is what we owe in the next 12 months, current liabilities. This is what we owe after 12 months. So now we want to know, well, how much all up do we owe? So this is current plus non-current liabilities. Together gives us our total liabilities. Right, so the last part of the balance sheet is to have a look and calculate net assets. So this will be using two items, the total assets figure and the total liabilities figure. So assets minus liabilities equals owner's equity. Well, you hope it does. So great. Assets minus liabilities, and then we have our net assets. Compare this figure to what you have got for your total owner's equity. If it balances, if it's the same figure, then you can do a bit of a celebration. You've probably done it right. Again, assuming that you have put expenses in correctly and assets in their correct elements, then it's probably right. If it doesn't, then you're going to have to backtrack. First, figure out, are there any assets that are that you've missed, that you haven't got? Are there any liabilities that you have missed out? Okay, so you'll have to go back to the trial balance to problem solve that. If that's not the problem, then you're going to have to backtrack back to the departmental accounts. Check that you've got every item in there correctly. Check that, and this happens all the time, that the calculations are done correctly. So that, for example here, cost of sales, opening stock, plus purchases, minus closing stock. That's your cost of sales, and then you calculate gross profit correctly. Make sure that the numbers, you haven't missed a figure, that you haven't written the wrong figure, and that when you transfer those numbers to the income statement, that the number hasn't changed. So that's another thing that you can look at. Assuming you've done that, then check that the profit is correct, check that the profit has gone into owner's equity correctly. And then you should be finding that it should be in balance. Okay, so that is a walkthrough of the 4 steps. So what have we covered? We've analysed the trial balance. We've gone through the departmental accounts, one for the food, one for the bar, and we've looked at the income statement preparation, and then we've done the balance sheet. Okay, so there will be one of these in the exam. It will be in a similar format. There is a practice test you can access on Canvas with a scenario there, or you can use the booklet that we've been using, printed out booklet, very similar in nature of what you'll be doing in the exam. So give it a go. So you will be doing that in the exam. So quite a few marks, 30 out of the 70 marks. So it is worthwhile getting it right, making sure you've laid it out all right as well. If you want to check your answers to anything that's there, the answers are on the student file drive. And also, if you're doing it in Canvas, the answers should come up on Canvas. Okay, thanks guys. I hope this has been really helpful if you've been wanting to work through the financial statements and get it all sorted. Thank you very much.